Welcome back to Macro Matters. This is instantaneous reaction to the latest Federal Reserve meeting. My name is Rich Excell. I'm joined by my co-host, as always, Tony Zhang. Tony, here we are, September 18th, Fed meeting, just in the books in the last half an hour or so, and we're here to discuss it. So always good to talk to you, and let's get started.
Yes, yeah, Rich, good to catch up, and especially this is a perfect timing for us to discuss about monetary policy that have been adopted by the Federal Reserve, which apparently is like out of a surprise to both of us. Even the market might actually price in more aggressively, but this actually turned out to be slightly out of my surprise. Though maybe we can continue to talk about how you think and what might be some underlying underlying reasoning behind the Federal Reserve for making such kind of an aggressive move.
Yeah, I mean, we've been on record obviously saying that we didn't think it would happen or should happen. I still kind of feel that way, and we can talk about that. But I think it's what's been really interesting, and I can't frankly recall a situation like this where if a week ago, and literally a week ago this time, the market was sold on the idea there was going to be 25 basis points, and it was the end of last week and early this week with some articles out in the Wall Street Journal, et cetera. A piece then put out by Bill Dudley, the former vice chair, calling for 50 basis points. Maybe it was some of the Democratic politicians calling for 75 basis points, but for whatever reason, the Fed Reserve decides to go on 50 basis points. And we'll look at the dot plots as well, because that was where there was a pretty big dislocation versus the market as well. But 50 basis points, and in the press release that I read afterwards, they talked about how the risks to inflation and jobs are balanced. And so I guess I would wonder why they say that they need to cut 50 basis points if those risks are balanced. Because to me, if the risks are balanced, there's no move needed, right? And the argument given is that the neutral rate's 3% or something like that. But the neutral, no one really knows. We both know, no one knows where R star or the neutral rate is. Everyone's trying to guess where it is. They don't really know. And usually the way we figure it out is by trying to see where the risks to inflation and jobs are balanced. And they just told us that they thought they were, and yet they're still cutting the rates. So it's a bit interesting.
Well,
But why don't I share my screen on some of the Bloomberg things that, as we've been doing the last few times, for those that are going to watch on video, you can see the Bloomberg screen. We'll try to walk you through what we're looking at here, for those that are on the podcast, et cetera. But the first thing I wanted to look at, which I think is maybe the argument to cut rates, and I think there are some arguments. I'm not saying there are none, but this is the NFIB small business capital expenditure plans, right? So this is what small companies are planning to expend on CapEx. And I overlaid it versus the two-year yield of what the market thinks the Fed's going to do the next couple of years. And as you can see, it's usually a pretty good fit. And when those CapEx plans are falling, the Fed's usually trying to cut rates pretty aggressively. And when those CapEx plans are rising, the Fed's usually in a mode to be kind of tightening policy. And this is, really over the last 30 something years. And so even on this period, it's a pretty good fit. And this is one where small cap companies have been saying that things have been pretty tough, right? The cost of capital has been higher. Small caps, of course, need to borrow from a bank. They're not going to borrow from the market. So those mega cap tech names that can borrow from the market at the long-term rates that are impacted as much by the inverted yield curve seem to do better. The small caps, we're struggling. And so I think this is one argument that might be one for cutting rates. So maybe one of the better ones I've heard on cutting rates. But what do do you think this helps, Tony? Does this now,
well,
when we start to see small
yes.
caps start to outperform?
Certainly, certainly. This is a good job by all means. What some of the market has already continued to advocate is that given the current some leading indicator within the economy, for instance, like the default rate over the car loan and some default rate over some credit card balance for many of subprime borrower within the U.S. economy today, given those kind of concerns that if the U.S. Still want to actually grow the GDP as expected, like roughly about 2.5 or 3% on annual basis, it's actually for good for Federal Reserve to actually take an aggressive step to cut like aggressively, like it's as what we have seen 50 minutes ago, 50 basis point this time. I definitely see some reasonable argument over there. However, historically have been told is the market would not actually respond as what investor has already expected most of the time, or especially in the past 4 times the Federal Reserve took the aggressive policy step to actually cut interest rate, as what we have show in the past like 4 or 5 episodes where we can I remember you show like how the stock market actually responds to the Federal Reserve aggressive rate cut, and all of us had been being what I say the push into the narrative or the information. The expectation is U.S. is going to get a soft landing within the economy. What a soft landing, what does that mean is we are going to see the low unemployment rate. And that's actually the central key piece information here. Because as the data, CPI data suggested recently that the CPI actually has cooling off significantly more, cooling within the range of 2 to 3%, very comfortable zoom by the central bank. And central bank historically, what they have already seen is in average, okay, since 1990, the like a neutral rate for interest rate is roughly about 2.8%. So given the CPI rate has actually reached to that comfortable zone of the central bank, I definitely see this could be some good things that Federal Reserve do cut interest rate. But here, taking a very aggressive move here, this is something that does actually does Fed see something that we don't see. Apparently, they have a lot of data that we apparently don't have access to. And I think this is what the investors should actually look at right now. And given I think the Chairman Powell is hosting the conference just live as being for now. I think this is what investors and what the market are really pricing and trying to watch, listening, just like very, very carefully. And based on my research recently, that I'm actually doing a research based on how the market actually respond to Chairman Powell's conference call versus the statement release. I do actually see something, the reinforcement effect. This is very interesting. What that's saying is if the statement like released like 30 minutes ago before the conference call has shared similar meaning as the Chairman Powell's within the conference call, that actually would show the market would actually go within exactly the same direction at a time when the statement was released. For instance, if this at a time that statement was released, the market actually went up, and if the message that delivered by Chairman Powell was the same as the information, no surprise, okay, cannot be a surprise. It would be the same as what the statement has already described. That the market will actually follow the same way, same trend. And I think this is very interesting that we are going to actually to see and listen, I think, for market to digest what he's going to interpret. I think a lot of folks out there would actually ask this question shortly.
Yeah, I think you're right, because this is the first meeting in a long time, as we talked about before, where there were really the market and the Fed were at odds, et cetera. And I think in the next chart I want to show is the dot plots, and that's another one where I think the market and the Fed were meaningfully at odds. And so if we look at it here, this is after the June meeting, what the dot plots were, because again they update the dots, what the Fed tells you the rates are going to, where they think the rates are going to be for the next 3 years. And you can see that the white line here on this chart is where the Fed funds futures were for the next year or so. And then we see where the median dots were. And the Fed was telling you by the end of 2025, interest rates will be around 4%. versus the 5.25 to 5.5 where we're starting. The market was saying they would be at 4% by the end of this year and 3% by the end of next year. So much, much more dovish.
Yeah,
Now, if we
Rich,
look at where if we look at where the market and the Fed are, the Fed stats came down to, just under 4.5% for the end of this year. So still seeing another cut. The market's still at that 4% for this year. But for next year, by the end of next year, the market's now below 3% and the Fed's below 3.5%. And so that's some still fairly aggressive cutting. Again, at a time when we're presumably are going to have a soft landing, which means not negative growth, but just slowing growth and no problem with the jobs, as you said, which is, of course, why the equity market's doing well, because if you think we're going to have a soft landing and rates are going to get cut aggressively, that's a pretty good backdrop, right? That's 1995 all over again. But I think you're right. I think I agree with you that the aggressive nature of this and the need that the Fed had to plant those stories with Nick Timiraos at Wall Street Journal, or even Greg Ip, or getting Bill Dudley to put something, tells me that they may be seeing something that the rest of us are not seeing. And that might be the small cap companies telling you that things are tough, or that the job market is more difficult. And so the Fed is actually coming more, closer to where the market is instead of the other way around. And I don't know if that is, the market's interpreting initially as this is soft landing, lower rates, all good. But I think I agree with you that maybe there's something that sounds more like a hard landing and not a soft landing.
Oh, certainly, Rich. This is a very, very interesting chart that you put it out there. As what you had already suggested, the white line actually shows the rate projection priced in by the market at this moment. So even with the 50 basis point cut today, that right now from the chart that you show, we are going to expect another or additional 50 basis point cut for the rest of the year. That being said, we only have two windows. One is November, the other will be the December. So that being said, is we are going to see maybe one more cut in November, one more cut in December. That's the only way. Or you can cut a 50 basis point right after the presidential election. And now here, I believe that even though Fed continue to say that they will become neutral in terms of political stance, and apparently how here is whether they are going to follow what the market pricing or market projection that is going to take additional cut in November's meeting. So that's actually right around the corner of presidential election. This is something very, very important. If that's the case, then probably we might see some major change within the political stance of central bank over maybe 20 or 30, even 30 years long stand. Here, apparently, as what we can commonly interpret it, when the market actually price in an aggressive cut or aggressive move of the central bank, then typically would show the different response from the market and different asset classes. Apparently, you mentioned about the small cap and some growth stock that I guess probably we can dive deeper into that later today. But here is apparently from the data plot, we definitely see a huge dislocation here. Now, here, how the market actually digests, the market apparently really believe that this will be a soft landing scenario. But the soft landing scenario from the Federal Reserve perspective, in the past, normally it does not care about too much of the market, as what we discussed last time. I think the last time from the Federal Reserve's statement, what we know is now the good news should be good news, the bad news should be bad news. And the only thing I think market is having this kind of aggressive move here is market trying to continue to believe Federal Reserve is giving the investors what they call a Fed put. Whenever if the market actually went down significantly, the Federal Reserve actually will cut the interest rate even further to lift the market. I don't know whether you believe this might be the scenario, Rich.
it certainly looks like that. So I don't really believe in the Fed put. I think the Fed cares about, I don't think the Fed cares about stock prices. I think they care about earnings, and we haven't seen earnings really negatively impacted yet. In fact, the earnings expectations for the next year or so are still quite aggressive. And in fact, I mean, maybe we can look at that really quickly. If I look at, if I look at the, the earnings expectations, for, let's see here, maybe I want to. So if we look at it, this is the S&P 500. This is the expectations for earnings. Actual earnings right now are around $234. So this is for SPX. For the next 12 months, it's a 10% growth rate. In a year plus, it's a 13% growth rate. I mean, we're still looking at double-digit growth rates in earnings. That doesn't sound like, that doesn't sound like the Fed, the market needs a put, right? That sounds like so, which is of course why stocks are rallying. And again, looking at like another thing that we've been worried about is, the bank's willingness to make loans. But we've seen, this is what I'm looking at here, is this is the Chicago Fed. They have a senior loan officer measure of just banks' willingness to make loans to commercial real estate. And again, you plot that versus the 2-year, and as of course the 2 years are coming lower, banks are more willing to make commercial real estate loans. Again, it doesn't seem to me like mortgage or like financial conditions are tight. We can look at mortgage spreads versus that, et cetera. I think to me, obviously, banks are going to be more willing to make loans. Credit spreads we know are already tight. Mortgage rates have been coming down lower. It certainly is making it difficult. But I think to you, one of the things I wanted to look at with you. Sorry if I can find it as I flip around here, is looking at the commodity markets, right? And the commodity markets are, I like to look at copper in relation to gold because it takes out all of the foreign exchange effects, et cetera. Copper, of course, more of an industrial commodity related to housing, electrification, and things of that nature. Gold just seemed to be as a safe haven within the commodity market. And if we look at this copper to gold ratio, it's at levels that we saw at the depths of 2008, that we saw in the in COVID, in depths of COVID, we saw it in the kind of mid-cycle slowdown in 2016. It's at a very low level, and I know we talked a little bit last time about China and the slowdown in China, but I think the other thing I wanted to kind of point out and to get your thoughts on this was the data that we got this week was from the ZEW German, the expectations of economic growth in Germany, another major exporting country, and those are collapsing as well. So somehow, I mean, I guess the feeling is the U.S. is going to have a soft landing, even though all the big industrial and exporting countries in both Europe and Asia are telling us things are getting really bad really quickly, which is what's getting reflected in the commodity market. So is it possible, do you think, Tony, that the U.S. is just going to chug along just fine, even though Germany and China are telling you things are looking pretty bad?
Well, that actually is a very good question. And as we are talking, apparently market actually just shift the sentiment from the green to red at Chairman Powell, as we are discussing right now. I actually certainly agree. I think that as the only scenario when soft landing become reality, the truth is that we continue to expect the capital flow into the U.S. market out from emerging market or other developed market like Germany or Europe or even including China, for instance. Like this is maybe the only few reason that I can see that we have a soft landing scenario. Otherwise, if we actually look in the globally, the demand has softened, and the PMI data from China is weakening, as what we discussed last time. And those countries are actually very industrial-like countries, which they determine the export. They mainly export to the developed countries, especially the U.S., where the U.S. consumer mainly actually demand. If we actually saw like the softening economy or industrial activities out there, and when we actually trying to expect there will be continued like a soft landing and high growth demands in the U.S. market. This is what condition needed to be there to assure this will be the case. Apparently, what you expect maybe from my point of view could be mainly three reasons. One is apparently there's no any other place better than US in the world to make it to actually to house the capital, right? This is like
Yeah.
now we definitely would think if this is the case, that only means that the whole world can be very bad, but the US just slightly better than the rest of the world. So okay, that might be one scenario. That doesn't necessarily mean that doesn't translate it to soft landing scenario. This just means that we are slightly better off than the rest of the world. And the second scenario will be is that whether the government or the central bank and same together with the U.S. government would continue to have the increase the debt to finance the fiscal growth, the fiscal spending for the U.S. government. This is actually something like a more concerning to me over the long haul, as what we have known, the percentage of the U.S. debt over the GDP has actually went over, I think, 100%, if that's right, Rich.
Yeah, it is. It is like
No, 100%. And given the condition is, given the situation, if we continue to have a high interest rate here, that means like the U.S. government will have to actually pay the high interest rate uh, in the year 2025 for whatever they actually going to raise for now. So this is something that the U.S. government had to face. The only thing that this will not become an issue is we will continue to see the inflation, because inflation is actually good for uh the the what we show the debtor, right? It's actually whenever you
yeah.
own other people's money that
Yeah,
it,
which is a reason why value tends to outperform in inflation, because those companies are the ones that are most levered, and it all drops to the bottom line for sure. Yep.
exactly. So this is something that really depends on which scenario would go. This will be the second scenario. The third scenario that would have most likely would happen is there was apparently with the technology innovation that's like, for instance, AI, which we discussed for 2 years already. I think if AI is going to increase the productivity of the companies so that the profits or the profit made by the U.S. public trading company will continue to grow at a rate like a double-digit rate, as what you just showed, 10% this year and 30% next year. Those will be this, I think, three possible tracks along the way. This is, I think, we are going to see the soft landing scenario. Which way will be the most likely one? It's like I actually would like to see it will be the third case, which means that the AI is going to lead the innovation, lead the disrupted change, fundamental change for the economy within the US. I think that's the best scenario. For the first one and the second one, it's just not sustainable. It's like even given what we have seen here, now the market actually completely shift the sentiment. So this is showing that there's still a lot of uncertainty over out there for with regard to how do we actually interpret the Federal Reserve like right now this policy move.
Yeah, and I mean, you mentioned the government debt to GDP is over 100%, 100%. It's actually, I think, closer to 130%. And this is just something that I was looking at earlier today. Then this is the Fed's balance sheet as a function of GDP. And we see that before the financial crisis, it used to be somewhere around 5 or 6%. Then after the financial crisis, it kind of shot up an average somewhere around 20% debt to GDP. And then after COVID, it jumped to a high of over 40%, and it's still about 33% of GDP. And so they've shrunk their balance sheet again from a high of over 40% to 26% by
Yeah.
about $2 trillion, but it's still materially above even where it was post-financial crisis. And to me, before you cut rates, you certainly have the flexibility to shrink your balance sheet by even more than this, because at some point maybe the Fed's going to want to have to buy some more U.S. government debt because no one else may want to buy it. But I wanted to get kind of your thoughts on some other things as well. And I just, while we were talking about earnings, I brought it up. here on that same screen to see what the S&P earnings were. I compared it to the Russell earnings. In the next year, Russell earnings are expected to be negative still, though there's a much higher growth rate in the out years. And so maybe to your point on that, the AI influence on the U.S. stocks is much higher for those, for those tech AI stocks than it is for those domestic growth companies.
Correct.
But I wanted to bring up the factors. We always like to look at factors and what the market's doing with factors. And if we look at just on kind of a 1 day, 1 week, 1 month, and I'm looking at the pure factors, and so we calculate this by it's a long short looking, at the top decile and the bottom decile, and so we're isolating the sectors as well, and you can see that size. So I mean so you would think that it clearly we're seeing these small cap stocks outperform over the last 1 day, 1 week, and 1 month. The larger companies are lagging, even though over the last year, year to date, 1 year, and even longer, large cap companies have been doing better. So the investors seem to be moving their money in favor of these small cap domestic companies, which would benefit from lower cost of capital. But we're not seeing that yet in the earnings expectations by any stretch. And so I guess the question I would have is that where there's an opportunity because the earnings haven't caught up with what investors are anticipating? Is there something else kind of going on?
Well, certainly, Rich, this is a very good speculation right here. Is typically when the interest rate goes down further than the market anticipated, that the long duration asset classes would outperform the shorter duration asset classes. This is always the case. Especially, this is something that what we have seen during the time of COVID, when those kind of ARK type companies actually rally without substantial earning improvements. This is what we have seen, and this actually would continue to prompt the speculation of the market, especially when the Federal Reserve cut the 50 basis point at this moment out of the surprise, and even we continue to see a strong data within economy right here. I would think, given that the fact that small cap Russell would actually continue to outperform, not necessarily from the earning growth expectation. That could be actually somehow what we can what from the market anticipate will be the expansion of the multiple. So if this is a situation even change better than expected, this could be two things. One is from the earnings expansion. The other is also from first expected is from the earning growth. The second perspective will be from the multiple expansion. So given the Federal Reserve cuts more, the multiple expansion by itself, without actually increasing of the earning per share growth for the Russell, that could by itself can raise the valuation for a small cap. So this is what had happened typically. But here is even within that, just like how the technology innovation, especially the generative AI, would have impact over different type of company. This is still worth, I think, selection and attention from the investor. But so we definitely should continue to focus those companies which can deliver strong earning growth and simultaneously capture the productivity enhancement due to the high the adoption of AI technology. That's just my thought.
I mean, and I think when you bring up that point on duration, I mean, we're definitely see that you see that not with just the size factor, but I'm looking also at the profitability. So the more profitable companies are lagging the less profitable companies in the last week. That's a change from what we've seen on a year to date and a 1 year basis. And the companies that pay dividends are lagging those that don't pay dividends. That's a change in the last week versus the last year or so. So definitely seeing a market that's seeking out duration. And I'm just one. I just want to look at this. So we're looking at the Treasury bond futures, right, which have been on a very strong run since really May of this year. Moving up over 6 points. Initially, interesting to me that as we're seeing this kind of move towards duration in the equity market in the last week or so, the bond market, which had moved first, is starting to roll over a little bit. Now the trend is starting to look like it's pretty strong, but our bond investors telling you that maybe we've kind of gone a little bit too far, too fast. So I think that's kind of interesting. And then the other one is the Russell. If I look at it on a longer term basis, if I look at the Russell futures, that definitely seems to be in a much better place, but they're still well below their highs that we've seen before. So is that something where you think investors are going to continue to focus? And then last but not least is the NASDAQ, which has, it's back off its highs here on the short-term basis. And it's, the AI theme is obviously alive and well in NASDAQ, but that chart looks a little less exciting than even the Russell chart. And I think one thing I wanted to kind of point out was and I'll bring it up here, is just the relative performance of Russell versus NASDAQ. And what we see is that from, remember at the start of the year, Russell did very well at the end of last year when there's expectation, I should say, of rate cuts. But then from January to July, as rate cuts were priced out of the curve, the Russell really materially underperformed the NASDAQ. And now, as rate cuts are getting priced back in, we're seeing the Russell move back higher, almost not quite to the highs, but back towards the highs that we saw at the end of last year. And so there's definitely this seeking duration in the equity markets is alive and well, and that's something. Is that an opportunity, or is that a potential risk?
Well, to me, definitely like more risk than opportunity. Certainly, as right now, as what I just actually mentioned, there will be only three scenarios going forward. Which one will actually become the dominant one that actually would determine the future performance of the market? And also, now here it's up for investors to actually make their decision. Now, from me point of view, if we actually looking at the second scenario, which will require the federal government continue to expand as the way, or even more aggressively than they are doing, or than they did over the past 3.5 years going forward. If President Kamala was elected or become the president of the United States, apparently what she actually has outlined from the policy, one thing's like probably might not be a major difference from what President Joe Biden is doing right now. So what that means is we continue to actually increase the government spending, enlarge the fiscal spending, simultaneously have to actually borrow more money, raising the government federal government's debt to actually to support the growth. That's the only way that I actually see that could be possible. Even she mentioned that she want to actually raise the corporate tax rate from where we are, roughly about 21 to 25%, depends on different type of company, to 28%, and slightly that she maybe proposed to have to impose some tax over unrealized gain, which to a certain extent will definitely give more pressures actually to the market. Apparently, market did not think that's gonna happen. But here is one expectation will be the government, no matter it will be President Trump or it will be President Harris, no matter who got elected, I think this will be the way that would continue to expand. I think that's how market anticipated, because anticipated this will be the case that to drive the earning growth of the public trading company. However, this is always however. Now, whenever the U.S. government raised the debt, and that someone had to pay, either us, either our future American citizen, American fellow, have to pay them back. This is no other way around. Is we borrow money and we spend money. Nowadays, like this is something had to happen, right, Rich?
Yeah.
And
No,
that's
I agree. And I'm
yeah,
bringing it, as you're talking, I'm bringing up the chart of the federal budget deficit as a
yes,
percentage of GDP. And we look at this over the last 50 years and we look at, usually we see budget deficits spike or, in this, and on this chart, it's set up so that when we're seeing a lot of government deficit spending, it's the line's moving lower. And that usually tends to occur around a recession, right?
yes, yes.
That's every time we've seen such a move um, towards more government spending, it's when we're in a recession. And that makes sense, right? That's what government spending is supposed to do.
Oh,
It's supposed to be
yes,
counter-cyclical. And here we are in a soft landing, presumably, and we've had some of the most aggressive government deficit spending for the last 5 years that we've had in the history of the United States in a time when the economy's been doing fine. And the question then is, how long can that continue without having some sort of impact? And we saw some impact maybe in inflationary terms, but how much longer will foreign investors, will retired Americans, will anyone that isn't required by regulation to buy government debt continue to buy this government debt? Because there doesn't seem to be any constraint on government spending shown by either of the candidates that we have in this election. But perhaps that's a discussion for another Macro Matters podcast. But I think that's a very good point. So here we are, just wrapping up the instant reaction to the Fed move, and we see that the stock market, which had initially responded quite favorably, has now pulled back to flat for the day. You're seeing a little, still some green here in the tech stocks, et cetera. Is this just a last word, Tony? Do you think this is just an idea of buy the rumor and sell the news, or was there something that came across your screen from the press conference that the market has maybe decided to be a little worried about?
yeah. I think this is a market reaction, pretty much match what the message that we deliver along the course of this episode, which is the uncertainty looking forward from the unnecessary or even or even surprise like a Federal Reserve cut 50 basis point move here. The VIX is a great risk expectation indicator, which was 17, I think, before the release of the statement. I think it still remains roughly about 17, 18 at this moment. It hasn't really actually gone down. That's why I think there's a lot of uncertainty going from the investor. And from what we just mentioned previously, here is it actually would take time for the market to digest what this is the message really meaning, because Federal Reserve has already passed the message in his last meeting that from now on he's not going to focus on the inflation, but rather actually focusing on the unemployment. But from unemployment, if we look at the corporate earning expectation, it will continue to deliver going strong. So now here we see the dilemma, and then the dilemma will be is does he cut just simply to meet the expectation of the market, or would he actually hold its independence of its policy? So I think that's where investors want to digest. We'll continue to see the volatilities like going forward. But the good news will be in presidential election year, typically in October, November, it turned out to be two good months, right? The worst month, which September, it's almost halfway done, but it's not completely done yet. It's just halfway. So I think it's very important. But going forward with what we just discussed, I still anticipate we're going to have a good bull years through the rest of the year, given the strong expectation growth. And if or no matter which presidential candidates be elected, I think probably it's the corporate policy and also with regard to the fiscal spending would continue. It just matter which one is slightly more aggressive. Which
Yeah,
one?
I would agree with you on that, and I agree with you on the seasonality where September's are usually a negative month, and this month it doesn't look to be that negative. but like you said, you know, as we go into October, November, and start talking about getting the uncertainty of the election out of the way and hearing more from companies on earnings, that is, and then of course, December, we always get that kind of fourth, you know, end of Q4 extension of whatever move we've had. And so it does look like it's set up for better returns for equity investors. Still, you know, very low rates priced in. And I think you're right that it's all going to be about the jobs at this point, because the central bank's telling us that those risks are balanced. And if all of a sudden they look like they're going to become unbalanced, then that probably would be worrying equity investors more than anybody else, because the commodity and bond investors already seem to be pricing that in. So on that note, thanks for joining us on this instant reaction to the FOMC meeting here on September 18th. And as always, you know, taking a look at the macro that matters, because that's what's important for investors, et cetera. And we'll look to kind of join you in another couple of weeks to continue to digest the Fed, but look into kind of setting up what earnings and expectations are, and what the election expectations are as we enter early October. Tony, thanks again for joining me.
Yeah, thank you, Rich. Yeah, I look forward to discussing with you over the next episode. I think which will be also very exciting given this the expectation, given the aggressive move from the Federal Reserve this time.
Thanks, everyone.